All right. Thank you very much. Is that the presentation supposed to? Yeah, I have slides. It's a red presentation. But in the meantime, when they pull up the presentation, I can introduce myself. My name is Herwig Springer. I'm the CEO of i5invest. i5invest is a startup factory, business angel investor and advisor for startups, later stage companies in the tech, IT and software space. We've got our main headquarters in Vienna, where we deal with the German-speaking and the CE market. And we've got a second office in the US in Palo Alto as well. According to our business model, which is investing as well as supporting with business development, corporate development, the two main markets that are relevant for us currently are Europe and parts of Asia and definitely US. So what I would like to talk about, give you some idea on how we approach the investment process, what is important for us, how do we value companies, and how do we organize an exit of the respective companies. If there are any questions, just jump in between. I'm happy to answer them. I covered it already. I jump on to some more technical issues. The questions we get very often: what do you look at when you want to invest in a company? What are the key criteria? We assembled the ones based on our experience of roughly 8 years of investing. The most important thing for us is the experience of the founder team. That you've got everything in place, everything is there, starting from finance to technical capabilities, and all the skills must be there. And what's really important for us, on the other hand, what's a clear no-go if the CTO is not part of the founder team. That actually drives probably at least 80% of our investment decision. Then of course there must be a product there that has some sort of USP, and if it's possible, the product should already, or the service should already show some traction. We've summarized here what we look at, for example, on transactional B2C business model, that you can prove that there's traffic there and you can follow the funnel down to actually a paying customer that generates revenues and margins for you. But to be honest, the product is something that's important and the product market fit, but that's something that will change. So again, the founder team here is the most important for us. If we go further down the wheel, the business model, of course, consistency of the business model, completeness, have we thought about all do's and don'ts and the different aspects? Scalability of the business model, we focus on software, so the business model is scalable, so we don't do service-oriented business models. Market potential, competition, so you should have an understanding of the market and of potential competitors out there. The saying that there's no competition because we're so new doesn't work very often, because very often it's not that true. Then business plan should be in place. Business plan not because we really believe the hockey stick figures, but it shows us that the founder or the founder team, they've familiarized themselves with the financial side of their business, and it's very important for us. Excellent proof of concept, basically, do you have customers, then show the customers and reference of the customers. And another thing which is important for you as a founder, you should make up your mind what a potential investor can bring to your company in addition to capital, and how you can work together, and do they bring a fair valuation on the table. And finally, you must be aware that even all angels are nice people and nice guys. They're financial investors, so they might exit at some time. So be aware that they'll stay with you and they want to exit at some time. So those are the key criteria that we focus on. Another important question that gets raised very often: how do you actually value a company when you invest? There are different methods. There is no clear right or wrong, and very often it's an educated guess or a very good gut feeling. But I can give you some approaches that we use regularly, or a combination of those approaches that might help you if you start a conversation with a VC or with a business angel who wants to invest. One method is basically the VC method, the venture capital method, where we look at what's the potential exit value of the company, what is the return we want to earn on our investment horizon, and the present value of that exit value, basically take into account the internal rate of return that we want to get, is actually the valuation of the company we are willing to invest. So it's driven by the exit and the entry value. Another thing that we apply, if it's possible that you can deconstruct your business model into different value drivers and assets you can bring on the table. Of course, tangible assets such as net working capital, machinery and equipment is not really important for most new economy business models. So what we focus on are more on the intangible sides. Do you have what's the technology in place? Do you have customers? What's the customer life cycle? What's the customer life cycle value? What is basically the value of the team? You can put some value on the team as well. And what is the value of the market you're actually try to conquer? And the combination and the sum of all those different assets, which are the value drivers behind the business model, for us make up the total value of the company. And the last approach that we use is some sort of benchmark weighing approach. Basically, we look into the different categories that are important for us that I presented on the first slide, like team down to product, market, whatever. We assign certain categories like 80% team, 10% product, blah, blah, blah. And then we benchmark that to our own experience. How good is the team in contrast to other companies we've looked at? How great is the opportunity in contrast to other companies we looked at? And then we can actually index the company. And with the weighing and the company, we can actually condense the whole analysis into one single index. And you usually have some sort of feeling about what's the pre-revenue, pre-money valuation for a startup for that region. It's very much regional driven and also industry-wise driven. And with that figure in head, you can actually come up with at least a rough guess of what the potential value of the company would be. Above 1 would be you will get a higher valuation than the average startup in your ecosystem. Below 1, you would get a lower valuation. And then, of course, you've got traditional valuation approaches that you might know, discounted cash flow, multiple. But to my experience, those traditional approaches do not work that well. So you have to be more creative. So if you want to discuss and answer the valuation meetings, it's good to have at least some framework that you can have, that you should have in mind as an investor, but also as a startup yourself. But in the end, again, all these approaches are really nice. It's all driven by supply and demand. Supply of good startup companies and demand for good startup companies, meaning money that's chasing good investment opportunities. That explains why sometimes valuations are different from fundamentals of the respective company, but it's you need to bear in mind, it's a negotiation in the end, the valuation. It's not like a true figure, and there's only one figure. It's a negotiation, and you're going to meet somewhere in between. Regarding valuations, or not valuations, investments, we pulled some figures here because we get asked very often, where does Europe stand in contrast to the US? It's probably pretty easy to answer. We cannot really compare those two regions because the US is so far ahead of Europe when you consider the amount invested in VC or risky companies. The US is leading like fourfold, and Europe is moving like sideways and not really picking up, unlike the US. The same thing is true, unfortunately. What's interesting, the median amount invested per each round. In the US, it's much higher. It's around 5 to 7. In Europe, it's around 2 to 3. And actually, that's already driven by places like London, Berlin. If you look at the average startup city, it's even lower, probably below 1 million. But the good thing is, it's kind of picking up. And the other good thing is, we definitely have room to improve. But in terms of money available and money invested, it's actually two different worlds between Europe and US. The same is basically true when you look at valuations. That's another question we get very often. We looked into capital markets, pulled it out of some databases, and we benchmarked. On the left-hand side, you see application software. That's actually a big group of all sort of software companies with ERP solutions, collaboration software, anything but outsourcing and data processing. And here you can see what is the average valuation in terms of enterprise value sales multiple in that region, Asia, Europe, and US. And you can see that here the US is leading with a margin of like 24%. If you do a deep dive into certain industries, it's even higher. It's almost 50 to 100%. For example, especially if you look into collaboration software areas. And interestingly, Asia has picked up quite well and has overtaken Europe in that scenario, and even has overtaken the US. So there's actually some momentum there. I don't know how sustainable that is, but actually pretty good sign for Asia that they're picking up and actually showing growth in areas not only on consumer manufacturing like Foxconn and the like, but also on more sustainable software companies. It's slightly different, but in terms of when you compare Europe to US, it's similar in the data processing outsourcing space. You see lower multiples here, of course, because it's a lower margin business. But again, the US is leading by far in contrast to Europe. So the two big differences are the availability of money that I've shown on the previous slide, but also the valuations you get for a US company. And the good side basically is that what we see is that valuations are so high and companies are so expensive in US that we see US investors are actually coming to Europe for various reasons. One is basically companies are cheaper, you get lower valuations. Secondly, compared to the US, or at least parts of the US, and I can say that for Austria, which is not a very cheap country, but in contrast to US or the Bay Area, we're actually a low-cost country in terms of engineers and availability of all sorts of resources, renting, housing. So it makes sense economic already to have some sort of foothold in Europe because it's cheaper and serve the US market at the same time. Then you can actually really significantly boost your valuations. Do you have any questions so far regarding valuations and investing? Okay, I take this as a no. What's interesting, we pulled some data for some major markets in Europe, and as we are in Turkey, we pulled data for Turkey as well. What we benchmark here is the amount of IT transactions in % of total transactions as a benchmark about how relevant is the tech sector for that respective economy. And the other benchmark we did, how international is the investor space in that respective country. If you look, for example, at very big markets like the US, you see that the tech deals in terms of total deals are around 15 to 20%, and the investors tend to be local investors, around 20%, which is driven basically that most big VCs are located in US. Same is partly true for the UK, especially around fintech. You see that very big startups are in London-based, and the same is true for fintech oriented VCs. Germany is slightly different, and it's picking up. But what's interesting here in Turkey, we see actually further improvement that it's around 15% now, the tech deals in terms of total deals. Of course, it's driven by cyclicality and how other industries perform, but we see that this could further improve. But what's interesting here, the number of, or the percentage of international investors is actually extremely high. It's around 80% or 70%, which is an indicator that there is a lack of local capital. So that's definitely something that needs to be improved. In fact, the figure for Austria is similar. What we definitely lack in lots of countries in Europe is that we do not have local VCs, and we have to rely on external VCs to get the funding, or we do have a lack of funding. And the final thing I quickly want to touch upon: how do we organize an exit process? It's basically similar to an M&A process that you're probably familiar with. But what we do is really we start with a business development perspective, benchmark the whole ecosystem, and reach out to very different parties in the ecosystem with a business development message in order to really come up with a long list of interested strategic partners. In order to have a better discussion, and a discussion about how can we grow the business together, which is better than basically we want to sell and you want to buy us. That's usually not the discussion you want to have throughout an exit process. And then once you've got a short list of really interested buyers, which could take quite some time if you don't do a straightforward M&A process, but a business development process. We actually do the straightforward M&A process from negotiation, from preparation down to negotiation, due diligence, and reach out. So it's slightly different from a general M&A process, but probably something, if you experience it yourself, something similar that you probably know yourself. Okay, I'm almost on time. Yeah.
And let's say you have a startup that ticks one or two of the boxes you mentioned, but they're lacking something. Why could you not ask them for these fixes in order to get them in the order where you want them to be?
You're meaning if you want to invest and then we say no because like we didn't tick 8 of the 10 boxes?
Yeah,
Okay.
if you're lacking only a few points, is there something that your company can do to help doing these fixes until it reaches the level that you're looking for?
Yeah, no, we can do that. We can help with business development. We can help with our network in order to like scale up in an early phase, and we can help with assembling. We can help with HR, like finding some people in more admin functions. But what's important for us that the core team, there must be a CTO in the core team that has a share in the company. There must be a CEO who can manage people, and there must be somebody who can take care of the finances, and there must be somebody who can do some marketing. That's really important. That's something you cannot just gather from the outside and then mix it together and hope it will be fine. Those are the 4 capabilities we really need, and all of them need to have like a significant share in the company. All right. Thank you.